Today's tutorial will be about reinsurance products. Now, for both SP7 and SP8, the first few chapters are exactly the same, so this tutorial will be applicable for both modules. Now, the first thing that we'll go into is what is meant by reinsurance. Insurance is typically bought by individuals or businesses and sold by insurance companies. Now, reinsurance is provided or sold by a reinsurance company and bought by insurance companies. But what about reinsurance companies themselves? They also sell a form of reinsurance to other reinsurance companies, and this is called retrocession, with the reinsurer purchases the reinsurance called the retrocedent, and the reinsurer who takes on the risk being called the retrocessionaire. So, who are the participants when it comes to reinsurance purchase? The brokers. These brokers act on behalf of the clients of the insurance company to obtain reinsurance on the insurance company's behalf. We also have direct placements where insurers may deal with reinsurers directly because of good relationships. We also have fronting. This is where insurer A, for example, underwrites a risk and cedes all or nearly all of the risk to another insurer, insurer B. Here, insurer B is a reinsurer and insurer A is the fronting insurer, and fronting insurer will receive a fee for its involvement. We also have captives. Captives are where another entity within the insurance company is set up to self-insure the insurance company. So those are the typical participants in a reinsurance purchase. Now we'll look at fronting in more detail with a part of the question. So here the Lloyd's Syndicate currently writes business only in the United Kingdom. It's been offered a large book of business comprising household insurance in Japan, which is being fronted by a Japanese insurance company. So here, the Japanese insurer issues the household insurance company policies to customers in Japan because only a Japanese licensed insurer can do so. It then reinsures most or all of the business back to the Lloyd's Syndicate here in the UK. The Lloyd's Syndicate ultimately carries the risk and receives most of the premiums, whilst the Japanese insurer retains little or no risk and acts primarily as a front to the syndicate. Now the question is, explain why an insurer might use a fronting arrangement rather than underwriting a risk directly, commenting on how this might be different for a Lloyd's Syndicate. So we're looking for 4 points. 2 to explain why they might use a fronting arrangement, and 2 points to explain how it might be different for a syndicate. The first point is that the expenses to the fronting insurer might be less than to underwrite the business directly themselves. Another point is that there might be tax advantages in using the fronting arrangement. Another point that we can do is the insurer might not be licensed to write business in the country of Japan, for example. This might be different for a Lloyd's Syndicate because they would have access to Lloyd's global license, allowing business to be written anywhere in the world. Now, another point is that the credit rating might be inadequate from the insurance company's point of view. But this might be unlikely for a Lloyd's Syndicate because they have the backing of firstly their own capital and Lloyd's capital. Now we'll look at the reasons for purchasing reinsurance. So why purchase reinsurance? The reasons for purchasing reinsurance come in the form of another acronym, PASSIVE, with the first one being to increase profitability. They are able to increase profitability and use their capital base to write a more diversified portfolio. The next is they can avoid single large losses. And these large losses might be large liability losses, like bodily injury claims. Another reason is to smooth the results of the company and reduce potential for fluctuations in profits. Another reason is to improve their solvency, because some of their liabilities for claims are ceded away to an reinsurance company. Another reason is that they can limit their exposure to either single events or accumulated events. And these accumulations could be either geographic or by peril. Another reason to purchase reinsurance is that they can increase their capacity to accept bigger risks. And the final two reasons are that the reinsurance company will provide financial assistance in the form of commissions and expertise in the form of knowledge. Now we'll look at two ways in which reinsurance is conducted. Firstly, with a part of the question. So, the first way of conducting reinsurance is through facultative or individual reinsurance. Now, facultative reinsurance is reinsurance of a single risk. This is where the reinsurer will be offered each individual risk for which reinsurance is required from the insurance company. There's no obligation to offer the risk from the insurance company, and there's no obligation to accept it. And the reinsurance company is free to quote whatever terms and conditions it sees fit. Now, part two for this question. The advantages is that it's flexible for both the insurance company and the reinsurance company. The insurance company can look around for different reinsurance companies for the best terms. And finally, the insurance company can write risks that are bigger than they originally intended. In terms of the disadvantages, it's very time consuming to place each risk, and it can be quite costly. And when you need cover, when the insurance company needs cover, it might not actually be available, or if it is available, it might have unfavorable terms. So that's facultative reinsurance, which is reinsurance with a single risk. Now we'll look at another way. This is the alternative, which is treaty reinsurance or group reinsurance. This is reinsurance of a group of similar risks under one reinsurance agreement. This is arranged so that the ceding insurer, the cedent, is obliged to pass all of the risks in an agreement on, and the reinsurer is obliged to accept all of the risks. This is called an obligatory basis. Now, alternatively, the arrangement might be facultative and obligatory, where the insurer has the choice of whether to include a risk within the treaty, but the reinsurer is obliged to accept all of the risks. Now, there are some advantages and disadvantages, with the advantages being that it's efficient for the insurer because risks are accepted automatically. It's also quicker and cheaper, and the cedant knows, the insurance company knows that reinsurance is available. With the disadvantage being that once the treaty is set up, it's very, very difficult, if not impossible, to change it until the end of the treaty. So those are the two ways of conducting insurance. Now we'll look at the methods of writing reinsurance. The first method is proportional reinsurance. This is where, for each risk, the direct writer, or the cedant, or the insurance company, cedes away a fixed proportion of the risk, passing on that same proportion of premiums, and the reinsurer pays that same proportion of claims. The insurer retains a smaller share of the large risk, and so can achieve diversification. And two examples of this proportional reinsurance is quota share reinsurance and surplus reinsurance. And the second reinsurance method is non-proportional reinsurance. This is where the direct writer, the cedant or the insurer, pays the reinsurer an agreed premium, and in return, the reinsurer covers the losses suffered by the insurer that exceed a certain amount. This is called the attachment point or retention, and this is up to a policy limit. And if the claim amount, however, exceeds the upper limit of the reinsurance, the difference will revert back to the insurer. And some examples of this are excess of loss reinsurance and stop loss. So now we'll look at the first example, which is quota share reinsurance. Quota share reinsurance is where the premiums and the claims, or the proportion of premiums and claims between the insurer and reinsurer is constant for all risks and treaty. And another note is that quota share reinsurance can also be written on a facultative business covering a single risk. In terms of the commission, the cedant will have their own expenses in writing the original policy, so the reinsurer will reimburse the cedant with a percentage of the reinsurance premium to cover these initial acquisition costs. This is called return commission. Now, the reinsurance company may also pay further commission to cover overheads for the insurance company, and this is called override commission. And the sum of these two, the return commission and the override commission, is called the ceding commission. There may also be a form of profit commission from the reinsurer to the cedant as a reward for passing on good business. And finally, in terms of commission, there might be brokerage, which is paid to a broker if it was used to obtain the reinsurance. In terms of the advantages and disadvantages, it spreads risk really well, allowing insurers to write larger risks. It can encourage reciprocity, where two insurers agree to swap business. It also improves the solvency requirement by reducing net written premiums. It can be very simple to administer, and the commission from the reinsurance company helps with cash flow. In terms of the disadvantages, the insurance company is passing on a large share of the profit with the insurance companies, and they are ceding away the same proportion of every risk, whereas the insurance company might want to vary this depending on each risk. So let's now look at an example of a quota share treaty arrangement. In this example, a direct writer has a 60% quota share treaty, and for a risk with a gross premium of £24,000, the reinsurer pays a 12% return commission and a 3% override commission, and will assume that there's a claim of £80,000. So what we want to do is we want to understand and calculate how much the insurance company retains in terms of the premium and cedes to the reinsurer, and also calculate the share of the claim the insurance company pays and the reinsurance company pays. So firstly, we know that the direct writer retains 40% of the quota share treaty, which is £9,600 of the premium, and the premium that's ceded away to the reinsurance company receives is 60% of this, which is £14,400. And as a check, we know that the sum of these must add up to the gross premium. In terms of the commission that is paid from the reinsurance company to the insurance company, the return commission is 12% of the ceded premium, which is £1,728, and similarly the override commission is £432. And recall that the ceding commission is the sum of these two, and that gives £2,160. So the insurer receives the premium, their share of the premium, plus this commission, which is £11,760, and the reinsurer receives their share of the premiums minus the commissions that they give to the insurance company, which is £12,240. And as a check, we can see that these add up to the gross premium. Now, in terms of the claim, the direct writer or the insurance company's share is 40% of the claim, which is £32,000, and the reinsurance claim share is 60%, which is £48,000. So, next we'll look at the second type of proportional reinsurance, which is surplus reinsurance. Surplus reinsurance is where the proportions are determined by the cedent for each individual risk under the treaty. Now, when issuing a risk, the cedent will have their own measure. The surplus reinsurance measure here is the estimated maximum loss. The EML is the largest loss that the insurer expects to arise from that single risk. Now, the treaty will specify three things. The insurer's minimum retention. This is to make sure that the insurer still has an interest in the risk. The insurer's maximum retention. This is to prevent very small proportions of risk to be passed on to reinsurers because of high admin costs to the insurance companies. And the number of lines of cover. This is the biggest multiple of the insurance company's retention that the reinsurance company will accept. So, for example, if a risk has an EML of £6 million and the insurance company's maximum retention is £2 million and the treaty specifies 3 lines of cover, then the insurance company should retain the maximum or could retain the maximum of £2 million and place the remainder of £4 million by 2 lines of cover, each line being £2 million. This way, the insurer would be liable for 2/6 or 1/3 of the risk, whilst the reinsurer is liable for 4/6 or 2/3 of the risk. And as a shortcut, as a rule of thumb, the premiums and claims between the insurer and the reinsurance company would be split in the proportion 1 to k, where k is the number of lines actually used. Again, there is likely to be return commission, override commission, and profit commission the same way as quota share, and brokerage if the reinsurance was placed using a broker. In certain situations, there might be multiple surplus treaties acting one after another. For example, one risk might be partly retained by the insurer, partly ceded to the insurer A for K lines, and partly ceded to reinsurer B for L lines. Now let's look at an example of surplus reinsurance with a past paper question. So part I asks us to state the advantages and disadvantages of surplus reinsurance compared with quota share insurance. The advantages, well, we need 10 advantages and disadvantages with 5 for each. So the advantages are the insurer can write larger risks than they used to. Surplus reinsurance is also more flexible. Insurance companies can choose what risk to cede and what proportion. They are good for avoiding large concentrations of risk. Commissions might also help cash flow, and it's also useful for classes with lots of variation in the size of trades. In terms of the disadvantage, it's more complex than quota shares to administer. It's also not suitable for lines with unlimited liability. It's not suitable for very small risks, otherwise the insurance company would retain the risk, and there might be unfavorable terms offered, as the insurer might select bad risks on purpose. Now, for part 2, we need to calculate A, B, C, and D. Now, to work out A, we can see that the treaty has 5 lines and a maximum retention of $1 million. To work out A, we need to calculate the number of multiples that the EML is of the retention. And from this, we get 5 lines actually used. Now, one of these lines is retained. So 4 is used to cede to the insurer, to the reinsurer. To work out B, the premiums are split in proportion. So in proportion 1 to 4. So the ceded premium is 4/5 of the original premium, which gives $27,840. To work out C, the number of lines, again, we need to use is 10 million divided by 0.8 million, which gives 12.5 lines. But the treaty, you can see, has a maximum of 5 lines. So C is limited to 5. And the other 7.5 lines is retained. Now to work out D, we have already calculated that the total number of lines used is 12.5. So the insurance company retains 7.5 lines. So the premiums are split in the proportion 7.5 to 5. And so the ceded premium is 68,000 times by the ratio of 5 over 12.5, which is 27,200. So next we've looked at both forms of proportional reinsurance. Now we'll look at non-proportional reinsurance, with the first being excessive loss. Excessive loss is a type of non-proportional reinsurance where the reinsurer covers the risk of any loss above a stated excess point, up to a limit. The insurance company typically buys excessive loss cover from different reinsurers to form layers. Here in this example, 2 million is the retention and is paid by the insurance company. The working layer refers to the initial layer above the retention, where moderate to heavy experience. These limits here on the side are often subject to inflation and are indexed, so that reinsurance companies do not receive claims just because of inflation, and these index limits are included in a stability clause. There are often reinstatements. Now, after multiple events, after a single event, the reinsurance company might allow insurance companies to reinstate the layer. This means the full cover is restored following a claim. Now, the reinsurance company charges a premium themselves, they calculate the premium themselves, so there is no need for any return or override or profit commissions. And now, going on to the advantages and disadvantages of excessive loss reinsurance. The advantage is that it allows the insurance company to accept very large risks. It reduces the risk of insolvency after a major event, and it also reduces claim fluctuations. In terms of the disadvantages, the premium that is given to reinsurance companies is most likely larger than the recoveries from the reinsurer, and it's difficult to price for a reinsurance company. It might take a lot of time. There are three different types of excess of loss insurance. The first being risk excess of loss. This protects against individual losses above the excess point and can be written on a facultative basis or on a treaty basis. The second is aggregate excess of loss, which is a simple extension where the excess point and upper limit refer to the aggregation of multiple claims rather than an individual claim. This covers the insurer for cumulative aggregate amount of loss more than a specified aggregate amount. And these aggregations could be by event, in which case individual claims might not be large but collectively might damage the insurance company, or by peril, where covers might be defined by a peril instead of an event over time. And finally, the last type of excess of loss reinsurance is catastrophe excess of loss, which covers an event of catastrophic proportion. And within this type of excess of loss, what is included is an hours clause. This is included to limit claims to all losses that is occurring within a consecutive period of 24 to 72 hours to be used within one catastrophe claim by the insurance company. We've looked at the first type of non-proportional reinsurance, which is excess of loss. Now we'll look at another type of non-proportional reinsurance, which is stop loss. Now, stop loss is a type of aggregate excess of loss reinsurance where the aggregation applies to all claims from a particular class of business during a defined period of time above an agreed limit. So it covers an entire class of business over a defined period of time, typically a year, and it's above an agreed limit. And layers might still be used. The excess point and upper limit are different and are often expressed as a percentage of the premium income, which is the loss ratio. And typically, the excess point is above 100% and can be and can move to an upper limit of around 130 to 140%. And stop loss reinsurance is only available on a treaty basis because it covers classes. Some of the advantages and disadvantages include that it protects an entire class of business rather than individual risks, but it has been historically unprofitable for insurance companies, and when they need stop loss reinsurance, it might not be available, and if it is available, it might not be affordable. So we'll now look at other conventional types of reinsurance. The first being financial reinsurance. Now, financial insurance is a contract, a multi-year contract, which transfers a small amount of insurance risk as well as investment type risks to the reinsurer. Typically, these contracts are multi-year, as I've said, and involve the insurer taking on less risk than a typical reinsurance arrangement. Now, the first example of this is a time and distance deal. Let's say, for example, an insurance company believes future claim payments are 1.2 million per year for 10 years. So what they do is they hold reserves 12 million. And based on payment patterns, it believes that the discounted value of these 12 million pounds of payments is 10 million right now. So what it does, it purchases a time and distance deal, paying 10 million pounds upfront to a reinsurance company and receives 1.2 million per year in return. Because the reinsurance company agrees to pay future claim payments each year, the insurance company no longer needs to hold those reserves. So these reserves of 12 million are released, but premium of 10 million is paid, and that leaves a net positive increase in our assets of 2 million. And you can see how this improves our apparent solvency margin. It also has the advantage that it could be tax efficient, and it could improve insurer-reinsurer relationships. Another example of financial reinsurance is a spread loss cover. This is where the insurer pays a premium which accumulates in a fund, and if a defined event or catastrophe occurs, all the claims are paid out of this fund. And at the end of the period, the balance of the fund will be paid back to the insurance company. The advantage of this is that it smooths profits and allows predictable premiums and lowers the capital requirements. And the disadvantage is that it uses a reinsurance company, of course, so that the credit risk so that there exists credit risk that the reinsurer might default. And of course, since the premium is paid into a fund, it's very inflexible. Another example of financial insurance is a financial quota share. This is similar to a normal quota share that we saw in proportional insurance, but this is for commission. In the initial period of reinsurance, the upfront commission paid by the reinsurer will be higher than a traditional arrangement, and the later commission will be lower. And the higher commission initially will help with the insurance company's capital position. Now, finally, we have industry loss warranties. This is a type of reinsurance where recoveries are based on the total insurance losses to the industry. Recoveries are only payable to the insurance company if they exceed a trigger amount. Now, this cover is usually defined for an actual peril, and payouts are usually typically very quick. So next we'll look at reinsurance for books of business that insurance companies want to stop writing. This is called run-off reinsurance. The aim is to treat closed book business and to transfer the risk that reserves may develop adversely. The book is sold in one case to the reinsurance company, who takes the premiums, the risk, and the claims reserves. And the situations when this is used is during corporate restructuring, during mergers and acquisitions, and any regulatory changes or accounting or tax changes. Now, the first example of this is called adverse development cover. This is where the reinsurance company agrees to pay any future claim payments on a book of business above a certain amount for a premium. This protects the cedent, the insurance company, from any reserve deterioration by capping the liability for the insurance company. The cover that is provided by the reinsurance company is for claims above a layer up to an upper limit, similar to an excess of loss. Any reserves are maintained by the insurance company still, and the advantages and disadvantages are that it does protect the insurance company from reserve deterioration, and the insurance company, because they still maintain the reserves, they can still receive investment income. In terms of the disadvantages, the insurer continues handling the claims and still incurs claims handling expenses. There is of course a risk of reinsurance default, and it could be very expensive. The next example of run-off reinsurance is loss portfolio transfers. This is where instead of the reinsurance company agreeing to pay future claim payments, all the liabilities for the book are transferred from the insurance company to the reinsurer for a premium which exceeds the existing reserves. All the reserves are transferred, all policyholders are informed, and court approval may often be needed. Now, some of the advantages are that the original insurer may have better credit rates after this transfer. The new insurer can achieve diversification, it might be cheap, and it's a quick method of exiting a block of business. The disadvantages is that court approval may be time consuming and may not actually conclude in approving the transfer. All the assets sold might be on unfavorable terms, and this might give a bad reputation of the original insurer if the new reinsurer defaults. So finally, we'll look at reinsurance of business by transferring risk to the capital markets. So, capital market products, the idea is that risk is transferred to investors rather than insurance markets or reinsurance companies. The first example of this is committed or contingent capital. This is where investors have a commitment to provide an insurer with capital after an adverse event occurs. The insurance company purchases an option to issue shares at a certain price if the event happens. For example, if the insurer's shares are £100, the insurer might fix the predetermined price at £100, and after the event, the market value of the shares might be £80, but the insurance company can still raise capital at the higher price. Another example of capital market products is structured finance. This is where reinsurers enhance the bank's loan portfolio by insuring it, improving the creditworthiness. Another example of capital market products is securitization. This is where the insurance company converts illiquid, inadmissible assets into liquid admissible assets for solvency, which improves the balance sheet. And there are three ways that we can do this. The first is insurance-linked securities. This is where the performance of the security is controlled by the occurrence of a defined insurance loss event. The insurance company issues a bond, for example a cat bond, a catastrophe bond, and investors pay money to purchase it. And these investors are entitled to a return of the principal and interest payments every month, every quarter, every year, but lose any payments, any future payment, if a defined catastrophic event occurs. And this is usually done via a special purpose vehicle for protection. And some of these advantages and disadvantages include that it might be cheaper, there's reduced credit risk, it's an alternative, it's a good alternative to traditional insurance, and the price is not affected by the reinsurance cycle. Some disadvantages include prices might be volatile, they might need to offer high interest rates for investors, and there's a lot of admin work. The second way of securitization is through securitization, where loan portfolios from banks are wrapped up and sold as bonds in a similar way to cat bonds. And lastly, we have motor securitization, where the claims experience of a particular motor portfolio is again sold as bonds, and any coupon payments, any interest payments to investors are foregone if the profit or the experience on the motor portfolio adverse. So that concludes our tutorial for reinsurance products.